Welcome aboard, everybody. Happy Friday. My name is Ilian Yotov. Familiar to many of you as the creator of the Quarters Theory. I host a popular daily program called the All Things Forex broadcast, Monday through Friday. You can find it on my website, allthingsforex.com. It is also syndicated on fx3.com and other popular Forex websites around the world. With that said, I'd like to thank our friends at fx3.com for putting together the series of webinars every Friday for our webinar outlook. And what we're here today to discuss is the trading week ahead of us, which is going to be another very interesting and more than likely crucial trading week, especially when it comes to the future fate of the U.S. dollar. As the U.S. dollar has come under pressure throughout the current trading week. Not surprisingly, as I explained last week, I said don't be surprised if you see the U.S. dollar beginning to be put under pressure if the U.S. economic data starts showing some weak spots, as we noted some weak spots with the retail sales coming a little bit less than expected. We saw a spike in jobless claims last Thursday, not yesterday, last Thursday. And then we saw the U.S. economy registering its largest trade deficit in 5 months last Friday. So that's the weak spots that I was referring to when I spoke about the U.S. economic data. And I explained also last week that in order for the U.S. dollar to continue to strengthen, we have to see U.S. economic data continuing to show us resilience. And I explained why. The reason why is because if the U.S. economic data softens, and begins to show that the economic conditions here in the United States are starting to deteriorate again after improving in the fourth quarter, then that would raise the odds for QE number 3, the so-called quantitative easing number 3, which is not completely out of the picture, as many of you know. We also discussed in recent weeks that some policymakers there at the Fed, including the Fed chairman, are warming up to the idea of, quote, the Fed doing more, which to me was the code word for QE number 3. And so next week, without any doubt, the main event next week is going to be the Federal Reserve's interest rate announcement. And that is why I said that the U.S. dollar is at least temporarily going to steal the spotlight from the euro, because obviously the euro is going to be on the forefront of things as we continue to monitor the situation with the Eurozone debt crisis. And speaking about the Eurozone debt crisis, we're going to start with the very first spotlight event for next week. It's going to come from the Eurozone with the Eurogroup meeting, the so-called ECOFIN meeting of finance ministers, which is going to be a 2-day meeting on Monday and Tuesday, January 23rd and 24th. And it's only happening a week before the actual European Union summit, which is going to start next Sunday on the 29th. So that's another big event that we are going to be discussing next Friday during this webinar. So the Eurogroup meeting is taking place Monday and Tuesday. It's going to be an important event, especially that we're now seeing a week of negotiations on private sector involvement for Greece. I don't think that it's producing a whole lot of positive results. There were some reports earlier this morning that there's going to be some sort of an announcement. Now, there were some announcements during a webinar last Friday, as obviously when I do these webinars, I don't have time to look at television or check out other websites for the latest news and announcements. But during our webinar last Friday, there were already some reports, some unofficial reports that there may be some downgrades as far as credit rating cuts for a lot of European nations. And the preliminary reports actually turned out to be true. Later on, as the day progressed last Friday, we saw the S&P cutting the credit rating outlook of France, which is the Eurozone's largest economy. Second largest economy in the Eurozone, and another 8 members of the 17-member Eurozone. So obviously, that was a big announcement last Friday. And throughout this week, we were paying attention to the Greek negotiations. It is very important for Greece for some solutions to be agreed upon there as far as private sector involvement for Greece to qualify to receive the next tranche of aid from the bailout funds that were promised from the European Union, European Central Bank, and the International Monetary Fund. An accord with bondholders has to be reached in order for the second financing package for Greece to be approved. And Greece is facing a major bond repayment. Some debt obligations are coming due in March, on March the 20th. And Greece is going to have to pay 14.5 billion euros. So the situation there is not completely resolved. There are some statements earlier this morning that came from the Greek finance minister who said that the climate was very good and the negotiations are progressing. The talks are going to continue tomorrow at midday, he said. And a statement issued by the Institute for International Finance confirmed that the discussions have advanced and described yesterday's talks as, quote, productive. Problem is, however, that people involved in the talks, one of the bankers there involved in the talks, told the Wall Street Journal that there is nothing voluntary about these negotiations. He said, we have a gun pointing at our heads, end of quote. And earlier this week, the Greek Prime Minister said that even if private sector involvement is not voluntary, they're going to pass some sort of a legislation in Greece that would force these private sector hedge funds and banks holding Greek debt to agree to the debt deal. So that, to me, doesn't sound like a very voluntary participation. So we'll see what comes out, whether later today or tomorrow. If there's news, the source told Dow Jones that an announcement is likely today without setting any time. I said on my program earlier this morning, usually when you have these announcements being made on Friday at the end of the week, it's not hard to guess the timing of that announcement. It would be probably after the European markets are closed or even after the U.S. markets close later on today. And if these announcements, that sort of announcement comes out after the markets close, in most instances, these kind of announcements are not very positive. They're made at the end of the week, ahead of the weekend when the markets are closed, so that they don't cause some major moves and sell-offs and so forth and so on. So hopefully it's not a bad announcement. Hopefully it's a positive outcome. Obviously, no one wants the Armageddon scenario, unless the people who are shorting the euro, obviously. No one else would want the Armageddon scenario to play out in a Eurozone debt crisis. But the Eurogroup meeting on Monday and Tuesday, all-day events, are going to be the first one of the important events that we're going to monitor throughout next week. We're also going to take a look now at the daily chart of the euro-dollar currency pair for the latest developments. And as many of you know, the euro-dollar pair has been in a strong negative trend in pretty much the second half, at least, of 2011. Since October, this is the high on October the 27th. The euro-dollar pair reached the sky, almost a large quarter point there at the $1.4250, and intraday high at $1.4246. And since then, since October 27th, since that peak, the euro has lost more than 1,600 pips. As we noted in recent weeks, the euro has declined to as low as $1.2622, which we have established a double bottom support in that area, $1.2622, $1.2624. Since that double bottom support was established, as I explained last Friday, one of the scenarios is the U.S. dollar to come under some pressure on as the market starts to gauge ahead of the Fed's announcement next Wednesday whether or not the Fed will continue to be accommodative with their monetary policy and maybe even consider a possible QE number 3 announcement of more quantitative easing. So the euro-dollar pair started a little bit of a price correction here. It has been strengthening for the last 4 consecutive trading sessions. dealing with the cluster of resistances ahead of it quite successfully, by the way, reaching as high as $1.2985 in a trading session today, about 15 pips below the $1.30 mark, an important price level in my quarters theory being the major large quarter point at the $1.30, that important junction that divides the two 1,000 pip ranges between $1.20, the $1.20s and the $1.30s, between $1.20 and $1.30, and the 1,000 pip range between $1.30 and $1.40. $1.30 is that dividing line, the dividing important junction that divides these 1,000 pip ranges. And when it comes to these 1,000 pip ranges and the 1,000 pip range transitions that I also explain in my book, The Quarters Theory, for those of you who are familiar with my methodology, in the last couple of months here on this program, we've been talking about the euro-dollar's attempt to transition its exchange rate from the $1.30s into the new 1,000 pip range below the $1.20. And I said that there's two requirements that I created with my quarters theory methodology that have to be met. The first one is for the currency pair to complete the first large quarter of a new 1,000 pip range. The euro-dollar pair has done that, obviously. The euro dropped below $1.30, completed the quarter between $1.30 and $1.2750. It even managed to move a little bit lower to $1.26 last week. Now, however, I explained weeks ago on this webinar program that that's not enough. My second requirement is on a pullback that takes prices back more than likely towards the major large quarter point, which would be $1.30 in this case. We want to make sure that the second requirement is met. And the second requirement is for the euro-dollar exchange rate on that pullback to stay below the $1.30 level. In other words, to stay in the new 1,000 pip range, which it transitioned in the last couple of weeks. That would be the second requirement that I have created in my methodology, the quarters theory, that could signal a decisive, successful 1,000 pip range transition. And ultimately, the way that that helps traders is to prepare them for the future price moves for the euro-dollar exchange rate in this case. If the 1,000 pip range in the $1.20s from the $1.30s is successful and those two requirements I just mentioned are met, then that could also mean that there may be further advancements. First of all, that could mean that the market is ready and willing to keep the euro-dollar exchange rate into the new 1,000 pip range, which is the $1.20s, and there may be further advancements of the euro-dollar exchange rate into the $1.20. In other words, further dip lower. The euro could dive even further into the $1.20s. And not only going back to the large quarter point at the $1.2750, challenging the recent lows at the $1.2622, but possibly even targeting the next very important level of this 1,000 pip range that the euro-dollar pair has recently transitioned within, which would be the major half point at $1.25, which is the exact middle point of the 1,000 pip range between $1.20 and $1.30. Those are the implications of and the benefits of my quarters theory methodology and how it could help traders as far as recognizing trend developments, price behavior, and ultimately gauge the direction of the next move with a greater probability of success in forecasting it. Now, that's what I'm going to watch next week when it comes to the euro-dollar pair as far as does the euro stay in the $1.20s. It's already pulled back almost 15, well, exactly 15 pips away from the $1.30 level. At this point, it's staying below $1.30. Will it continue to stay below $1.30, which would be ultimately a sign of weakness? It would be a sign that the market wants to keep the euro-dollar exchange rate into the $1.20. And then ultimately, in the days and weeks ahead, we could begin to see the euro continuing the direction of the previous established trend, which it doesn't take a rocket scientist to see where the euro's trend has been in at least the last several months since that peak in October. The euro has lost more than 1,600 pips from the high at the $1.20, $1.42.46 to the lows at the $1.26.22. up to 50% price correction is possible. 50%, many traders know, is so-called perfect retracement. 50% of 1,600 pips means 800 pips of a bounce higher for the euro versus the US dollar. So on the other hand, although the euro could continue that previously established trend going forward, don't be surprised either if the euro-dollar pair does, if the market decides to do so, and especially if the Fed weakens the US dollar, because you know that if the Fed announces next Wednesday that they're going to decide to stimulate the economy even further, that is more than likely going to be at the expense of the US dollar. If the Fed announces QE number 3 next Wednesday, the euro's price correction could extend further, and it could go beyond the $1.30 level. So you should be aware of such scenario, although I think that the latest U.S. economic data throughout the fourth quarter, and in October of 2011, on this program and on my All Things Forex program, I explained that the market is going to start a quest in October, and I'm quoting my exact words, to find out, starting in October of 2011, at the start of the fourth quarter of 2011, the market will start a quest to find out whether the U.S. economic conditions are really as bad as the Fed's gloomy outlook painted them to be. It's exactly what I wrote at that time. And what we did, if you followed me on this program regularly every Friday, or if you followed me on my All Things Forex broadcast on a daily basis, you know that throughout the fourth quarter of 2011, the U.S. economic data has shown signs of improvement. It has shown signs of resilience, with the exception of a few weak spots. I mean, we know that the housing market is not going to improve unless the labor market improves. But I've been more focused on the labor market rather than the housing market, and we certainly have seen some signs of improvement from the U.S. labor market. As long as the U.S. economic data continues to show signs of improvement, the odds of QE number 3 by the Fed, which would ultimately be the biggest risk for the U.S. dollar strength, are going to diminish as long as the U.S. economic data continues to show strength. As soon as you start seeing the U.S. economic data deteriorating, QE number 3 could be deployed very quickly because the Fed has not completely dismissed QE number 3. It's not completely out of the picture yet. And I think that the U.S. dollar could continue to be under pressure on QE3 expectations ahead of the Fed's announcement on Wednesday. But if the Fed dismisses QE number 3, does not hint that QE number 3 is going to come sometime in the near future, if the Fed does not extend their promise to continue their accommodative monetary policy beyond mid-2013, which was the previous time frame that the Fed promised for the accommodative policy to continue, then I feel that the U.S. dollar could start seeing some more strength after the Fed's announcement is behind us, provided the Fed doesn't weaken the dollar further and doesn't announce further debasement of the U.S. currency by doing more quantitative easing. So don't be surprised if the U.S. dollar continues to stay a little bit under pressure ahead of the Fed's announcement. However, after the Fed's announcement, and we're going to see if the Fed does not announce QE number 3 or does not open the door to it, the dollar could strengthen. And then on Thursday and Friday of next week, we're also going to see some important economic data coming from the United States, which we'll talk about in a few minutes, that is going to be very important for these reports to show strength in the U.S. economy. Next week, we're also going to watch the Bank of Japan's interest rate announcement. Now, I don't expect any kind of changes in the Bank of Japan's current monetary policy. Their interest rate is practically 0%, pretty much the same policy as the Federal Reserve. They're doing more quantitative easing. They're ultra accommodative and so forth and so on. It will be interesting to see whether the Bank of Japan will say something about the Japanese yen strength, especially versus the euro, as the euro, as you may recall earlier this week, has reached new record lows versus the Japanese yen, a new 11-year low, but still staying about 800 pips or so above the ultimate all-time low for the euro, which is below 89 yen. It's not below 100 yen. It is below 89 yen. So the dollar is staying now above 77 yen as we speak. I'm not expecting the Bank of Japan to do an intervention next Monday morning or late Tuesday morning or late Monday night. They don't normally give us an exact time for their announcements. But it will be interesting to see whether they will say something about the strong Japanese yen. And it will be also interesting to me to find out if they're willing to do more quantitative easing, because it sounds like and it looks like the Japanese economy improved in the third quarter of 2011. But now that we're starting to see the numbers coming out for preliminary estimates for the fourth quarter economic growth, the concerns are that the Japanese economy is deteriorating again in a last quarter of the year, fourth quarter of 2011, and it will be interesting for me to find out if the Bank of Japan will do more quantitative easing, ultimately, as a tool to stimulate the economy, but it's also a tool to weaken their own currency, the Japanese yen, and whether that's going to be have an impact on the Japanese yen. Ultimately, we'll find out what comes out from the Bank of Japan on Monday night, early Tuesday morning. But then after that, on Tuesday morning, we're also going to pay attention to a sequence of important Eurozone economic data that could help us gauge economic conditions in the Eurozone. The Eurozone flash estimate, which is a preliminary estimate of the so-called Composite Purchasing Managers Index, which gives us the manufacturing and the services indexes there in the Eurozone. That's coming up at 4 a.m. Eastern Time on Tuesday. And many of you know that on a regular basis every week we pay attention to these economic reports from the Eurozone. And as far as the Purchasing Managers Indexes are concerned, they have been below 50, which is contraction territory. Now, in recent couple of months, couple of recent reports actually have shown these indexes climbing a little bit higher, but still below 50, which is contraction. The 50 is the dividing line between economic expansion and contraction. So a reading below 50 indicates contraction in that particular sector. The manufacturing Purchasing Managers Index came up to 46.9 in the previous month. Now the forecasts are expecting a reading of 47.4, which would be a little bit of an improvement, but still below 50 in contraction territory. And the Services Index is expected to reach 49.1 from 48.8, a little bit of an improvement yet again, but still below 50 as well. So we might see another month of contraction in the services and the manufacturing sectors of the Eurozone's economy. Why is that important? Well, it is important because more and more economists, as we've noted in recent weeks, are already forecasting that the Eurozone economy may have already started a recession in the fourth quarter of 2011. And you know the definition of a recession. You have to have 2 consecutive quarters of negative economic growth, of a contraction in the economy. So if the Eurozone contraction has already started in the fourth quarter, and then we see another contraction in the first quarter of 2012, then those would be the 2 consecutive quarters that would give us the definition of a recession in the Eurozone. And even the European Central Bank President, Mario Draghi, has warned about the possibility of a, quote, mild recession in the Eurozone. So, no surprise to see the European Central Bank deciding to cut interest rates, undoing Trichet's 2 interest rate hikes very quickly last year. Now, in January, the European Central Bank decided to keep the status quo, to keep rates at 1% level. But if conditions continue to deteriorate in the Eurozone's economy, it would not be surprising, as I've been saying all along, to see further interest rate cuts by the European Central Bank. And that would hardly be positive for the euro. As I explained previously, it erases the Eurozone's euro's yield advantage over other lower yielding currencies. If the European Central Bank continues to cut rates, and there are some major banks and forecasters there are expecting that the European Central Bank could cut rates to 0.5%. That means another 0.5 percentage point of rate cuts to come in 2012 in order to avoid the double dip and the recession and so forth and so on. So that's why it's important to see whether the Eurozone economic data will improve or continue to weaken, which could increase the odds for the European Central Bank to cut rates even further, which ultimately, coupled with the fears of contagion from the debt crisis and fear that Greece may default and may ultimately be one step closer to exiting the Eurozone and the Euro. All of these factors coupled, combined together could create the perfect storm for the Euro's weakness to continue even further. So that's the report we'll watch there on Tuesday morning. On Tuesday night, we have the important data from Australia, which is the Consumer Price Index. The Reserve Bank of Australia is another one of the major central banks, which is expected to cut rates further, possibly as early as their next meeting on February the 7th. Last week on this program, and I'll show you the daily chart of the Aussie dollar currency pair, I said that the Aussie dollar pair is strategically positioned for a bullish breakout, the Australian dollar versus the US dollar. We drew a line last week, and I said this is the resistance, triple top resistance to watch between $0.0378 and $0.0385 area. Now that area was broken above earlier this week. The Aussie dollar pair today is reaching as high as $1.0480, which is pretty much a completion of the large quarter to $1.05, exactly as I expected would be the case. A move towards $1.05 and previous resistance at the $0.0499, which I'm sure was not really that much of a coincidence there, with the large quarter point being at the $1.05, an important level in my quarters theory. So I said that $1.05 area could very quickly get to be targeted if the Aussie dollar pair does find the catalyst that it would so desperately need, and I'm quoting my exact words from last week, by the way. I said that the Australian dollar will so desperately need a catalyst to propel it higher, to break that triple top resistance versus the US dollar. Well, the Chinese GDP report earlier in the week showed the Chinese economy growing a little bit faster than the consensus forecast, which is always a positive for the Australian dollar, given the close relationship between the Australian and the Chinese economy. China is the largest trading partner of Australia. So obviously the Chinese stronger economic growth in China, it means more demand for Australia raw material exports. No surprises there to see the Australian dollar strengthening. And I said that even the labor market report from Australia might serve as a positive catalyst and could give the Australian dollar a boost, which was not the case because the Australian employment report on Wednesday night was very disappointing, showing the Australian economy losing jobs unexpectedly for another consecutive month. And that raised the odds that the Reserve Bank of Australia could actually consider an interest rate cut as early as their next meeting in February. They've already cut rates twice in the previous couple of months. So another 25 basis points of a rate cut is expected, if I'm not mistaken, according to a Bloomberg index based on interest rate swaps, future swaps, I think. Yesterday was pointing the odds of another cut in February by the Reserve Bank of Australia being about 84%. Which is a pretty high probability for another cut by the Reserve Bank of Australia. So I think that despite of the bullish breakout for the Aussie versus the US dollar, if the Fed dismisses QE number 3 next week, the Australian dollar, the US dollar could find some strength, and the Australian dollar momentum, that bullish momentum, could begin to falter. And of course, the next immediate level of resistance is the area of the large quarter point at the $1.05. If that level is broken above, then we'll watch this area here around $1.06.5 area approximately, and then ultimately the large quarter point at the $1.0750. Did you really think that this was a coincidence? Well, that's too many coincidences. Let's count them. 1, 2, 3, 4, 5 times in a row. The Australian dollar encounters resistance a little bit above the large quarter point at $1.0750, with the latest high being $1.0752. Only 2 pips above the large quarter point, another important level in my quarter theory at the $1.0750. A decisive break for the Aussie above $1.05, and the Fed announcing QE number 3 or hinting towards announcing it in upcoming months could really extend the Australian dollar's gains versus the US dollar, despite of expectations that the Reserve Bank of Australia could cut rates as early as February. But if the Fed dismisses QE number 3, and we get to see the markets beginning to be concerned once again about contagion and the Eurozone debt crisis and the default by Greece, then that's going to cause more risk aversion. And if the Reserve Bank of Australia is expected to cut rates in February, that could put the pressure again, and the Australian dollar could start losing that upward momentum that it has gained after the bullish breakout that occurred earlier this week. So the Reserve Bank of Australia expectations for a rate cut and the risk aversion are going to be major risk factors for the Australian dollar. On that note, technically it is a bullish development that that bullish breakout has occurred earlier this week. And it's important for the Australian dollar to maintain that bullish momentum, but what's the risk factors that could cause for the Aussie to lose it? Another important report on Wednesday morning is due from the Eurozone, with the largest economy there in the German IFO Business Climate Index, the leading indicator of economic conditions there. And Germany is probably the only one that is doing well and better than the rest of the Eurozone members, obviously. The IFO index follows the ZEW index from last week, which was better than expected. Len is chiming in very quickly on the daily chart of the Australian dollar. He said, looks like an ascending triangle. I've been talking about this ascending triangle. Great observation, Len. I've been talking about it for weeks now. What he's referring to is that a pattern that you have that triple top resistance and a flat line, and then you have those ascending highs where we get to see every new high that the ascending lows. Every new low that the Australian dollar made in recent months was higher than the previous low. So when you connect these lines with the ascending lows and the flat line, that's the ascending triangle, which is also a technical pattern that's known to many traders to be a leading indicator of an impending bullish breakout that happens in most instances. Does it happen all the time? There's nothing that's guaranteed. Nothing is 100% guaranteed in life and in trading especially. But when you get to see these ascending triangles, they're a leading indicator or could serve as a signal to a potential impending bullish breakout. And that's something that I've also been talking about when it comes to the Aussie dollar technical developments. Because on this program, we pay attention not only to fundamental developments, but also to technical developments as well. We combine both of them in order to gauge the next moves for these currency pairs. Thank you. Great observation, though, as far as the ascending triangle. Now, let me go and show you very quickly. I think it would be a good learning experience for the novice amongst us. Here is the line that I drew here with the triple top resistance around $0.0378, $0.0385. And you can see these ascending lows. In other words, every time, hold on one second, this chart is not cooperating very well. Every time the Australian dollar makes a new low, every new low is higher than the previous low. And when you connect these ascending lows, you get that triangle, that's the ascending triangle, ultimately could serve as an indicator of an impending bullish breakout. All right. Moving forward with the important economic reports, the IFO index, the ZEW index from the Eurozone was better than expected. That's also a leading indicator of the IFO index, which is due on Wednesday. And the business climate index is expected to show a reading of 107.7, which would be a little bit better than 107.2. I would not be surprised given the ZEW index last week coming up better than expected if the IFO index is even stronger than the consensus forecast. So that could be another kind of promising, I would say, report that could show some signs of improvement, the so-called green shoots from the Eurozone economy. But don't get too excited about improvement in the Eurozone economy. At least the International Monetary Fund is not getting too excited about the Eurozone economy. In their draft, which was leaked earlier this morning to the Daily Telegraph in the UK, a draft is IMF and the World Economic Outlook, which is due to be published next week, says that the global recovery is threatened by the growing tensions in the euro area. It estimates that the Italian economy is going to contract by 2.2% in 2012, that the Spanish economy is going, the Italian economy is the third largest economy in the Eurozone. Spain is going to contract, according to this outlook by IMF, by 1.7%, and the Eurozone economy is expected to contract by 0.5% in 2012. That is a downward revision from the previous estimate, expecting the Eurozone economy to grow in 2012 by 1.1%. And the report, according to this draft, encourages the European Central Bank to continue moving to a more accommodative monetary policy, end of quote, which is in line with what I was explaining earlier, that I wouldn't be surprised to see the European Central Bank being forced to cut interest rates even further, especially if the Eurozone economic conditions deteriorate. But on Tuesday, with a flash estimate of the purchasing managers' indexes from the services and manufacturing sector, they're a little bit better than expected. And the IFO index from Germany, if it's better than expected, that could give the euro a little bit of a boost, especially if the market continues to put the dollar under pressure ahead of the Fed's announcement. However, be aware of the potential for the dollar to find some further strength in the aftermath of the Fed's announcement if the Fed dismisses QE number 3. Next week, we'll pay close attention to the British pound, a couple of risk events on Wednesday morning for any British pound further strengthening, despite the fact that the pound is now trying to break above $1.55 large floor point. As we've discussed in recent months and weeks, the pound-dollar exchange rate is still confined pretty much in the same range that it has been confined within since, what was it, October or so of this year. On Wednesday morning, we're going to watch the UK gross domestic product report, the preliminary estimate for the fourth quarter economic growth, and also at the same time, 4:30 a.m. Eastern Time on Wednesday, we're going to see the Bank of England's meeting minutes. Both of them are very closely related reports, and I'll explain how. They're very closely related because the Bank of England has recently decided to expand the size of their asset purchase program, which is their quantitative easing program, by another 75 billion pounds, currently at 275 billion pounds. That means more quantitative easing, more money print, which is hardly beneficial for a country's currency. The expectations are, and the current size, the current program operations expire, will be wrapped up in February. And the expectations by the market are that the Bank of England could be forced into doing more quantitative easing, given the potential for a recession in the Eurozone and also in the United Kingdom, with both of them also very closely related because the Eurozone is the largest trading partner of the United Kingdom. So a recession there could ultimately have a negative impact on the UK economy. Now, in the third quarter, UK economic growth was revised higher to show 0.6% economic growth. However, the consensus forecast for the preliminary estimate for the fourth quarter GDP, which is due next Wednesday at 4:30 a.m. Eastern Time, is expecting the United Kingdom's economy to contract in the fourth quarter. Not so much by 0.1%, but nevertheless to contract rather than to expand, which would be obviously a risk event for the British pound in a way that a contraction in the UK economy opens the door to further quantitative easing by the Bank of England, which is not going to be beneficial for the British pound. This is why I said that these two events on Wednesday morning will be risk events for the British pound. Now, for the time being, and I'll switch us over to the daily chart of the pound-dollar pair. For the time being today, we're seeing, or throughout this week, we're seeing the euro correcting some of its losses versus the dollar, and we're seeing the pound correcting losses versus the dollar as well. After a brief, what is going on with this? My mouse is not cooperating today. My apologies. After a brief break below the bottom of the existing range, which was $52.70, the range I drew for you in the last couple of weeks since October has been, the bottom has been $52.70, the top was $61.65. Last week, after the credit ratings downgrades last Friday, we saw the pound breaking below $52.70, reaching as low as $52.33. And after that, it quickly climbed above, and throughout this week, it has been staying within its existing range. Now, there's a smaller range within that larger range here, and I will show you which one that is. There's a triple top almost resistance here around $57.79, and the recent lows at what was that area here? $53.5 area. So the pound-dollar pair has now entered that smaller range between $53.5 and $57.79, and currently it's about halfway through that range to the large quarter point of the $1.55, intraday high today $55.39. It could continue to trail a little bit higher if the dollar is put under pressure ahead of the Fed's announcement. But watch on Wednesday morning. Watch on Wednesday morning for these two risk events for the British pound. With the GDP, if it shows contraction in the fourth quarter, which could raise the odds of the Bank of England to do more quantitative easing going forward, possibly as early as their next meeting in February or March. And that's where we could see, and if on Wednesday afternoon the Fed dismisses QE3 probabilities and they diminish, then the dollar could find some support as well. And we could see the pound beginning to lose that momentum. And it could start trailing back towards the bottom of that smaller range towards $53.5 area and possibly to the bottom of the larger range at the $52.70. So watch the risk events on Wednesday for the British pound. Going forward, after Wednesday's important events from the UK, we're going to see the main event of next week on Wednesday afternoon. The Federal Open Market Committee interest rate announcement is due at 12:30 p.m. Eastern Time. You'll recall the historic announcement by the Fed earlier this year, earlier in 2011. For the first time ever, the Fed decided that after 2-day meetings, they're going to have an announcement which will be made at 12:30 p.m. Eastern Time in the U.S., and it will be followed by a press conference by the Fed chairman, which is due at 2:15 p.m. Eastern Time. So anywhere between 12:30 p.m., the time of the announcement, and the press conference at 2:15 p.m. will be potentially volatile time in the markets. The markets will gauge the next move by the Fed. I'm not expecting a QE3 announcement. However, I think that the Fed will keep it in its arsenal as a tool to stimulate the economy if economic conditions deteriorate. That is why I've been saying all along, the U.S. economic data must continue to show resilience in order for QE3 odds to diminish. As soon as we find and start seeing the signs of economic conditions deteriorating in the U.S., the odds of QE3 will exponentially rise and the U.S. dollar will be put under pressure as the market starts pricing in these expectations. This is going to be the key to the Federal Reserve's interest rate announcement as far as gauging the future monetary policy of the Fed and its impact on the U.S. dollar. Now, following the Fed's interest rate announcement, we'll see another major central bank, the Reserve Bank of New Zealand, announcing interest rates. And the Reserve Bank of New Zealand, if you follow me on this program, has been surprisingly hawkish. Unlike the other major central banks, which have focused in the fourth quarter of 2011, they have focused their attention and efforts on economic growth, stimulating economies with more accommodative monetary policies. The Reserve Bank of New Zealand has been keeping rates at 2.5%, but every time they've met, the statement that was issued was a lot more hawkish, hinting to potential interest rate hikes that could come in the near future. And the New Zealand dollar, with the dollar being put under pressure ahead of the Fed's announcement throughout this week, and some improvement in economic data and conditions and investor sentiment on positive bond auctions and so forth and so on from the Eurozone, all of these factors have come together not only for the Australian dollar to break higher versus the US dollar, but also for the New Zealand dollar to produce a strong bullish breakout versus the US dollar as well. And let me see here if I can put the Kiwi dollar chart really quickly on. Okay, here we go. This is the daily chart of the Kiwi against the US dollar. Now, many of you would recall that we had some previous resistance. Well, of course, you have the major large quarter point being here at 0.80 cents, an important level in my quarters theory. That level was broken above. This was the resistance that the Kiwi dollar pair broke above earlier this week. The resistance was right around 0.7980 or 73 or so. After the breakout occurred, the New Zealand dollar a couple of days ago reached as high as 0.8081. There's two levels of resistance that it's still attempting to break, and that's 0.8068 and 0.8108, with the most important one of the two being 0.8108, and also the high from a couple of days ago, 0.8081, is also going to be an important level. So you have to watch these three resistance levels now that the Kiwi is pulling back to the large core point at 0.80 cents. It's also important to see what price will the New Zealand dollar close at. Will it close the trading week at the end of the trading session today? Will the New Zealand dollar close above 80 cents or below it? It could give us a hint of signs of strength or weakness from the New Zealand dollar exchange rate versus the dollar. In a way that if it closes above 80 cents, I think that would be, to me at least, a sign of strength. And a sign that there may be an attempt for the New Zealand dollar to continue further above that 80 cents level, back into the previous 1,000 pip range. After transitioning into 0.70 this 1,000 pip range, between 0.70 and 0.80 cents, now it seems like this week the market is trying to transition the New Zealand dollar exchange rate back into the 0.80s. And this is why if the New Zealand dollar takes out these resistance levels, a little bit above 81 cents, and then moves to target that important price level in my quarters theory, which would be the large quarter point at 0.8250, you didn't really think that the high on October the 28th, which was 0.8241, was a coincidence, did you? It's 9 pips below 0.8250, large quarter. And that would be the price level that the New Zealand dollar challenges. The large quarter point area, again, at 0.8250, that the New Zealand dollar challenges if it should break further above 0.8108. And, of course, if investor sentiment continues to improve and risk appetite increases and ultimately the world economy doesn't really change. In other words, as a higher yielding commodity currency, the New Zealand dollar and the Australian dollar will continue to be dependent on these two factors. Strong risk appetite, strength in the economy, which increases the demand for raw material exports from both Australia and New Zealand. And of course, if the Federal Reserve hints to more accommodative monetary policies and hints to further U.S. dollar debasement, the New Zealand dollar could be a good alternative as a play on further U.S. dollar weakness. This is why the bullish breakouts that have happened earlier this week with the Australian and the New Zealand dollar versus the US dollar should not be shocking. If I had to choose between the two, I would say that there's a greater probability that the Reserve Bank of Australia could cut rates. On the other hand, the Reserve Bank of New Zealand will not be in any hurry to start cutting rates, but on the other hand, they're not going to be in a very much of a hurry to start raising rates either. Because earlier this week on Wednesday, we had the Consumer Price Index report from New Zealand, and it was expected to show inflation increasing by 0.4% for another quarter in New Zealand, which means if inflationary pressures are rising, then ultimately a central bank may be forced into raising interest rates to curb higher inflationary pressures. Well, inflation, the Consumer Price Index in New Zealand unexpectedly declined rather than increased in a fourth quarter. So it was not a report that increases the odds that the Reserve Bank of New Zealand will speed up the process of hiking interest rates in the near future as early as next Wednesday. I'm not expecting them to hike rates. They will keep them benchmarked. More than likely, the benchmark interest rate will be kept at 2.5%. But if they issue another hawkish statement and they maintain their hawkish stance, that would continue to be supportive for the New Zealand dollar as well. So we'll watch to see whether the bullish breakout that occurred earlier this week in a New Zealand dollar versus the US dollar currency pair will have a follow-through, a follow-out next week. If it doesn't, obviously, the New Zealand dollar could start losing some of that momentum and could start declining further versus the US dollar dropping below 80 cents and falling back into 0.70s 1,000 range, more than likely heading back towards 0.7750 large quarter point. If the breakout has a follow-up and the New Zealand dollar maintains its bullish momentum, we could see the resistance at 0.8108 being challenged. And if that level is decisively broken above, I would not be surprised to see a completion of the large quarter between 0.80 and 0.8250 large quarter point with a target of the resistance area at 0.8241, high from October 28. So these would be some of the implications of the upcoming Reserve Bank of New Zealand interest rate announcement on Wednesday afternoon at 3 p.m. Eastern Time. And then, of course, after that, we're going to finish the week with a sequence of important U.S. economic data. Following the Fed's announcement, I said it's going to be crucial for the U.S. economic data to remain strong, to show resilience, to show the Fed that the conditions are not deteriorating, which would force them, obviously, to do more quantitative easing and continue to be ultra accommodating. On Thursday morning, we're going to see the durable goods orders and the U.S. jobless claims at 8:30 a.m. Eastern Time, followed by the new home sales from the U.S. I'm not expecting miracles, as I said in the beginning of the program, from the housing market data, but at least the unemployment claims have been a good leading indicator of improvement in the U.S. economic, in the U.S. jobs market. Yesterday, we saw a very significant decline in jobless claims from 399,000, the spike from last Thursday. Yesterday, we had a significant decline to 352,000. They might bounce a little bit higher, according to the forecast, to about 370,000 next Thursday. But as long as they stay between 375,000, I've been like a broken record on this program. Throughout 2011, I've been talking about 375,000 being the number that economists estimate the jobless claims would have to start declining below 375,000 in order for us to see a consistent improvement in the U.S. jobs market and a significant decline in the U.S. unemployment rate. And certainly in recent weeks, we have seen jobless claims finally starting to decline below 375,000. As long as they stay below 375,000, I think that would be positive. And the durable goods orders next Thursday morning are expected to increase by 1% month over month, from 0.3% in a previous month. That could be another positive report from the U.S. New home sales are expected to increase slightly to 322,000 from 315,000. And then on Friday will be the second most important of the U.S. economic reports next week, with the main gauge of economic activity and growth in the world's largest economy, the U.S. economy. And let's do a little bit of a comparison here. Remember earlier I mentioned that the consensus forecasts are pointing to the United Kingdom's economy to contract by 0.1% in the fourth quarter. The U.S. economy grew by 1.8% in the third quarter of 2011, which was a downward revision from the preliminary estimate, which was about, 2.5%. It was revised lower to a final reading of 1.8%. Now, next Friday, the preliminary estimate for the fourth quarter GDP growth in the U.S. is expected to show a reading of 3.1%. That's an increase from the 1.8% in the third quarter, and it's a heck of a lot stronger economic growth compared with the contraction that's expected in the UK. And it's also a heck of a lot better than a forecast contraction in the Eurozone. As I said, the IMF, in a World Economic Outlook, which will be published next week, is expected to forecast that the Eurozone economy will contract by 0.5% in 2012. And more economists in recent weeks, I've said, are forecasting already that the Eurozone economy may have started a contraction in the fourth quarter, which could begin a recession in the Eurozone. So Friday's GDP report from the U.S. will be a great opportunity for traders to gauge economic conditions in all of these regions and compare U.S. economic growth with growth in the U.K. and growth in the Eurozone, and ultimately gauge the next move in policies by the central banks and the future moves of these major currencies, the dollar, the British pound, and the euro. I'll have to wrap things up. We're running out of time. I'd like to invite you to listen to my daily All Things Forex program, Monday through Friday on allthingsforex.com. You can also follow me on Twitter for latest updates at allthingsforex. At allthingsforex is the Twitter account. Thank you to our friends at fxstreet.com for putting together these webinars. Thank you all for joining me today. Have a great day and a great weekend, and I will see you again next Friday.